and special meeting of March 7th.
Move to approve the minutes of the regular meeting held February 27th and the special meeting held March 7th, 2018.
I'll second.
Any discussion on the motion? We have a motion and second to approve the minutes of the regular meeting held February 27, 2018, and the special meeting held March 7, 2018. All in favor indicate by saying aye.
Aye.
Opposed, same sign. And that motion carries. The next item on the agenda is the city manager's utility activity report.
As you have the report in your packet, just highlight that probably more of interest to some people is the in the water department. We'll probably be seeing a few more water service repairs, although we've had kind of a normal winter, if not maybe a little bit higher than normal as far as water main and services break. This is the time of the year when the frost goes out of the ground, and all of a sudden we have a few more noticed repair projects that need to happen. In another month or so, we will be past that that particular spot in time, and it can settle down. Why is that going so slow? I'll go up this way. Just for informational purposes, the employee of the month was Darlis Bodie. She's a clerical assistant 1 in the PUC administration department. Darlis has been employed by the public utilities I don't think since November 1983. She's prior to that she's employed by the city, so the combination of the city and the PUC since 1983. There was a no read, no consumption on a meter at a location. Darlis caught it, and it saved probably a disastrous event from occurring, and the fact that the meter was not the right meter that was reinstalled caught it and solved a problem before it became a problem. So she's our employee of the month because of her attentiveness to detail and knowing what meters should go into what locations. She is also the gas department administrative help, where she takes all telephone calls, assists customers, and helps PUC staff when needed. So that is Darlis Bodie's Employee of the Month description. The other item I just want to point out is that Shauna Boomgarden and I met with Roundhorse, the consulting firm we're working with to search for a utility director, and their basic report was they had approximately 400 plus potential candidates. They weeded out about 100 and some just because they didn't, we're not going to be the kind of person that would come to fill this position. They got down to about 300, and they're continuing to work and weed them down. I suspect that they'll be reaching, probably 100. They did present to both Sean and I resumes of individuals that would be considered for this position, and I can tell you that they were some really good background people, experience in public utilities, and I'm looking forward to seeing the final 5. So we're moving ahead with that. We're at the it was called the calibration point, if you remember, in that discussion, to where they presented numerous resumes to us, and we said, these are not the ones we're necessarily interested, but these are, so focus on these backgrounds. And now they've done that, so they should be narrowing down that list of probably 200 plus down to a list that they'll present to us in the very near future. So looking forward to that. So moving ahead. That's all I have.
Okay, well, we recognize Darlis Bodie as our Employee of the Month.
I'll make a motion to receive and order filed the report regarding utility operations during the month of March 2018.
I'll second.
Is there any discussion on the motion? We have a motion and second to receive and order filed the report regarding utility operations during the month of March 2018. All in favor indicate by stating aye.
Aye.
Opposed, same sign. The motion carries. Our next agenda item is to receive a report from the New Ulm Economic Development Corporation Coordinator.
Brian Toll, New Ulm Economic Development Corporation. You've got my February report in your packet. I'm just going to highlight a few things. Mr. Gromnitz and I met with the president of J.R. Schugel Trucking regarding potential plans for expansion and how the city could provide any assistance. I would also like to point out that we're in the final stages of planning the 2018 Career Expo, which will be on April 4th. So right around the corner. We expect between 40 and 50 businesses participating in the booths presenting, and we expect about 600 students. We have ongoing discussions with DLC Manufacturing regarding their expansions. We have entered into a contract with them to sell them a lot in the airport industrial park for their expansion. And we are also in ongoing discussions with Windings regarding a potential expansion for them. Any questions? If not, thank you.
I just note for the members of the PUC that Mr. Toll has met with city and PUC staff this last month to kind of go over all of the different activities that are going on in the community and looking for opportunities. And I'm glad to say it that we did it, and I hate to say we should have been doing it for probably long time already. I think it was beneficial for both staff and PUC at the city, maybe for Brian also, to get a greater understanding of all of the activities.
Never hurts to communicate.
Yeah.
And we hope to invite the new city assistant administrator economic developer to our meetings, along with Mr. Schnobrick. We hope he's willing to attend those. Thank you.
I'd offer the motion to receive and order filed the report from the New Ulm Economic Development Corporation Coordinator regarding activities during the month of March 2018.
Second.
Is there any discussion on the motion? On the motion and second to receive and order filed the report from the New Ulm Economic Development Corporation Coordinator regarding activities during the month of March 2018. All in favor indicate by saying aye.
Aye.
Opposed, same sign. And that motion carries. Next is a presentation from BP Energy Corporation. And Chris Manderfeld, or just BP?
Well, yeah, I think we'll start off. I mean, I'm more than happy to let Chris come up and explain the whole thing and introduce our members from BP Energy Company here. But we met earlier before the PUC meeting to kind of talk about the nitty-gritty details of what we're attempting to do here. And who we have with us today, I'm going to just go off the business card here, is Donald M. Black. I see we've got Bill on there. I don't know if you go by nickname Bill or something, but Donald Black is what's on his card, and Paul Miller from BP are here. And this is kind of a unique opportunity that is being offered to us that a few of our fellow municipal utilities are trying to take advantage of. And I think we'll kind of turn it over to Mr. Black, and he can kind of explain what's going on for the benefit of the PUC members here.
Thank you. And I don't go by Bill, and so I don't know what's on that card that I gave you, but
well, it's on the issue sheet, and I'm going, I have your card, it's not lining up. But you can call me Bill if you want.
No, so I'm good. We'll just go with Don. So thank you for inviting us to present to you today. We're here to talk about you joining us in a natural gas prepayment transaction that we're pulling together. The prize here, the reason why you're considering doing this is something that's unique to municipal systems such as yourself. And it's the ability to, through the structure we're going to talk about today, by, I guess I'll say, price advantage gas. And so the prize we're talking about is up to 20 cents per unit of gas delivered to the city that you participate in this program. Okay? And please feel free to interrupt me and ask questions on every page except for this one. This one I need a lawyer for.
You got one.
Yeah.
There you go.
So we like to, so here I'm on page 3. I understand that everything I've got here you've got on your screens as well as we have it up there. And what we're doing here is try and explain the transaction in its aggregate, in its totality. But before we get into what this means, I just want to explain that your role is the box in the far right labeled participant. The city of New Ulm will be one of probably maybe 20 or more participants that we're inviting into this transaction, every one of which is a municipal gas LDC, local distribution company, or a municipal electric generator, so public gas or public power. And the reason for that is that the laws that govern these types of transactions, is essentially tax law, requires that the participants are qualified participants. And and it's in the code that what is a qualified participant is a municipal gas LDC that buys gas for resale to your retail customers, or a municipal electric generator that buys gas to run through a municipally owned generation unit to make electricity for resale to your retail customers. And so this is a structure that is unique to the public power space. And it's actually unique to the United States as well, because we have this concept of federally exempt debt, or when our municipal systems, whether it's a state, county, city, or in this case a utility division sells bonds, it's exempt from federal taxation. And that creates the opportunity. But you're on the right in this box. And so your obligation will be to enter into a contract with an entity that's described as PEAK, that stands for Public Energy Authority of Kentucky. It's a long-term gas supply agreement. It's a take and pay agreement. So what that means is that you will only pay for volumes that are delivered to you, as you are doing today under your existing supply contracts with hopefully just BP, but I suspect probably a few other people as well. The difference being is that the price you're going to pay is going to be the index, or the monthly price you're used to pay, you normally pay, minus a benefit. We're talking about 20 cents here, or at least 20 cents in the future, okay? But that contract is for 30 years. And so 30 years is a long time by any standard, and it's a long time for us as well. And the reason why it's that long is that the math of the transaction, the benefits of it, are maximized, are best derived through these very long-term contracts, okay? And if we get into the detail of that, and I'm happy to do so, we're really peeling back the onion quite a bit. But I will tell you that the reason for that number is to generate the types of benefits that we're talking about, okay? So I'm going to clear this diagram, and they're going to get into somehow some of the details here. So you're going to face a company called PEAK, and that stands for the Public Energy Authority of Kentucky. And PEAK is a municipal entity, similar to yourself, organized under state law for the purpose of doing these types of transactions. And that means that they're going to sell tax-exempt debt to enter into a long-term and prepay for a long-term gas supply contract from BPEC. That's us on the left. So we got the participant, that's you, we got PEAK, and now we got BP Energy Company on the far left. So PEAK's going to sell 30-year bonds, 30-year nominal maturity bonds, and use the proceeds, about $1 billion, and they're going to pay BP for a long-term gas supply contract of 30 years. And the volumes associated with that contract will be the aggregation of the volumes that have been committed by the different participants to the transaction. So your contract that you're going to sign with PEAK is going to have a volume schedule associated with it over its life. And the totality of volumes will be the sum of those for all the different participants that are in the transaction. Not all of them in the Midwest. We're inviting participants along the Gulf Coast states and some in the Mid-Atlantic states as well. The Carolinas, Virginia, maybe even up in the Northeast. So we've got 3 of the boxes taken care of. Peak is selling bonds, so that's the bondholders down the bottom. The key thing for you is that these are not your bonds. So the city of New Ulm will in no way be responsible for this debt. This is Peak's debt. Your only responsibility is to enter in this gas supply contract, take delivery of the gas, and pay for the gas that you're delivered. And because you're qualified load, okay, so you're the reason, along with your other participants, you're the reason why these bonds are exempt from taxation. Because you're qualified load, you will commit that when you take volumes, when you take gas, you will use these volumes first, okay? And the reason for that commitment is that to support the tax exempt opinion, to create line of sight as to qualified use, we want to create that priority. Now, this isn't or shouldn't be a very difficult one for you because odds are this is your cheapest gas. That's the whole purpose for the transaction is you're creating price advantage gas. So here, I'm going to talk a little bit more about the BPEC and Peak. So how do you come up with $1 billion prepayment? What does that, how do you do that? And so you need 3 things. You need a known volume schedule over time. So that's going to be the aggregation of the different participants' commitments. You need a price deck. We have to put a price on all those volumes over time. Price times volume is cash flow. And then you present value that to today. Okay? So what do you mean by present value? So future dollars are worth more than today's dollars. You bring stuff back to today. And then we're going to give this money to BP. BP views that money as being analogous to if we had borrowed it. In fact, we're going to account for this transaction as debt. So the $1 billion that we're going to receive is going to show up in our balance sheet as a borrowing. When we do that, when my Treasury Department does that, they view that in the context of what they would otherwise pay for debt. So they can, on any given day or week, they can call the capital markets, any one of the dealers that we work with, and raise $1 billion. And that will cost a certain interest rate, whatever our rates are, whatever our credit is commanding at the time. Okay? That becomes a discount rate. So volume, price, cash flow brought back at essentially our borrowing rate. That's how you calculate a prepayment. Our borrowing rate is higher than the rate that Peak is selling the bonds at, because our borrowing rate is in the taxable markets and Peak's bonds are in the tax exempt markets. And that differential is what's creating the engine that creates benefit for municipal systems. Okay? And now we're getting into a little bit more of the complex part of it, which is that we have now entered into a 30-year fixed price gas sale contract with Peak. And they don't want to buy for 30 years at a fixed price, and we don't want to sell for 30 years at a fixed price. So coincident with closing, simultaneous with closing, we're going to enter into swaps, financial instruments, that convert that fixed price back to floating. And that's what's happening across the top here. You'll notice that we are facing a box that's labeled back-to-back swap to be determined. So this is a participant that we're currently in discussions with different potential participants about serving in that role. Names you've probably heard of, like JP Morgan is one of the candidates, Royal Bank of Canada, Wells Fargo is another one, and Morgan Stanley itself. Okay? And out of that, we're going to choose one that best fits the transaction. But from your perspective, just understanding what happens upstream of you, the result of that is to take the fixed price assumption and calculating the prepayment and convert it to monthly floating price. So that now everybody involved is buying gas, in your case, or delivering gas, in our case, essentially on the same basis as we do now, which is sold at a monthly price, but now with this incremental benefit driven by the transaction. So a natural gas prepayment transaction is at its core a long-term gas supply contract, but it's woven into a structured financing designed to capture the benefits of tax exemption versus non-tax exemption. Any questions at this point? Clear as mud?
What's your cut?
Our cut?
Yeah, so if, in this example on the sheet here, if we get 20 cents a therm, are you guys getting 20? Are you getting 80? You know, how does that
So we're gonna get less than you, but I'll go ahead and take you through some of the fees, because that's what you're really getting at, is how many, who's making money upstream of you. So the first thing we get, though, and the reason why we're in this, and I'll tell you a quick story to get to this point. The reason why we're in this is we get a long-term gas supply contract with a very important customer segment to us, which is the municipal systems. We're the largest gas marketer in North America, and the muni segment has always been very important to us. And the reason why this is an important story, and it's very important also for my tax counsel who gets involved in this, is that when we've been involved in these types of transactions in the past with other people. And my Treasury Department, who is part of our deal approval process, the number 30 gets their attention as well. My Treasury Department is part of the deal approval process. When they learn more about this, the current structure that we're operating under, the USA guys made the case to London that we should now weave this in as part of the group financial framework, meaning this is how BP finances itself, okay? London said no. And the reason why London said no is that the complexity of these, and there's gonna be a stack of paper that high in support of everything that happens upstream of you, the complexity wasn't worth the incremental benefit in a low interest rate environment. It's very easy for a company our size to raise $1 billion. And so the local people, Paul and I, made the case to London that if we're borrowing anyway, let's borrow in a way that benefits our North American merchant gas operation. And so they gave us $1 billion to work with, and that's why we're talking to you today. What the different marketing and origination teams have done is they've had to go through their list of clients and identify the ones they want to invite into this transaction. We're oversubscribed. I'm the subject matter expert. That's why I'm talking to you. This is your relationship gas supplier from BP. This is why I'm here, okay? So the first thing we get is a long-term gas supply contract. We're also not doing it for free, okay? So we're gonna make somewhere in the order of 7 cents an MMBTU on the volumes that we're delivering to peak to be redelivered to you, and you're gonna make more than that, all right? The back-to-back swap counterparty is probably gonna earn somewhere in the 2.5 to 3 cent range. That's kind of the market for that type of role, all right? And then Treasury is going to, they've been moving around in the benefit that they're probably going to save anywhere between 5 and 15 basis points against what they would otherwise be able to borrow money for in the market, just for the incremental complexity associated with this transaction. So that's what's kind of driving what's upstream of you. Does that answer your question?
Pretty well. So I have a follow-up question.
Excellent.
So if we give you guys first rights on gas supplied to the utility, and we don't use that much gas.
Yep.
You know.
So let me just rephrase what you said, because it's not first right. So you're entering into a gas supply contract, so the volumes that you're taking are known by the contract.
Yep.
So it isn't a first right to deliver to you. You've entered into a supply contract with known volumes. What we're asking you to do is that if you consume volumes at all, you consume these volumes first, because it's called tax advantage or bond advantage volumes.
Right.
So if you have a supplier from someone else that isn't tax advantage volumes, then you would take these first. And the reason is because you're the qualified load. So we want to preserve that.
Right.
But the question you have, and it's a good one, and we'll get right into it, is over 30 years, a lot of things can happen, right? A lot of things can happen. And we had this same debate at BP about, getting into 30-year gas supply contracts as well. One of which being 22 years from now, you can have some invention, some widget that is created that makes natural gas no longer a viable energy source. Nobody's using natural gas. And so from your perspective, what happens is that if you can't take what you've committed to for that reason, you've lost load, you lost some industry, you lost some people, or there's another widget out there that's better, and you can't take it, then you have a mechanism to push your volumes back into the transaction, okay, to be remarketed by us to try and find other qualified load around the United States, right? So we were going to have to replace you if you can't take the volumes for whatever reason.
And John,
for
the
good
key
reason.
thing is with proper notice, there's no financial penalty back to you guys.
Mhm.
Right, yeah.
Yeah, I'm just thinking about, we have a 60-degree February.
So,
Yeah.
so in a 60-degree February, you're going to take some volumes, but the volumes you can't use under contract, there are two mechanisms in the contract. One is you can make them up within the month or then the following month. So if you say 60 degrees or 45 days, but absent that, then you can push them back into the deal to be remarketed. But the big one is that if you push it through, so now we've got the volumes back, peak and then us, and we can't find qualified load elsewhere, then we're not using the volumes according to law, and we have to shrink the transaction. We're going to have to repay some of the monies that we were prepaid to peak size to reduce the amount of bonds to whatever the consumption is at the time. Did I answer your question there?
Yeah, so basically, they end up losing the benefit on those volumes.
So you lose the benefit of your bargain because you're not, obviously you can't earn,
The downside is you no longer get the 20%
Right.
discount for those particular volumes you turn back.
Right.
So, okay, so now I have a third question.
please.
So then if we enter into this and we know what our history has been over the last 20 years.
Yep.
Do we go and say, do we go with like our average usage, or do we do 80% of our
Yep.
of our mean, or what's the recommended?
Yeah, so Don, let me just take that one on, is working with Chris, and Chris, feel free to chime in, but long-term, she's looking at.
Paul, could I have you go up to the
Sure.
microphone? So.
In our discussions right now with Chris is looking at 20% of your portfolio on a long-term basis. And then also we have a short-term pricing opportunity too. And stuff that you already have fixed price with us, we're looking at converting all that into the program. It's a lesser discount, but it's still real savings to the people. So anyway, that's our plan. I would tell you that some of your cohorts are maybe a tad bit higher at 30%. And I think part of the planning on your guys' end is the risk with these things are really is there a better one that comes down the road 5-10 years down where interest rates are higher or gas prices are higher. Certainly the repricing mechanism that Don will go into will mitigate that. But I think that's part of the planning is to hold back some volumes that you guys have put together. We'll tell you some of the Southeast LDCs that we deal with, they're putting 70 to 80% of their volumes into these type of programs, just as a comparison.
Yep, so well said. So I'm going to add that just in a couple of ways. One is, so the information packet that was just sent to you guys, I think it was yesterday, that includes a form of the agreement and then a questionnaire sent by Peak, has some, does ask some questions about what your historical consumption patterns have been. And so the information packet serves two purposes. One is to create tax counsel the ability, give them the ability to diligence your historical consumption to make sure that your future commitment to this transaction is in line with that you don't overcommit. So that's one, and so that'll be a diligence point. And the other one is we want to collect information on you because there is a bond offering that's being done. There's an offering prospectus associated with that, and New Ulm will be disclosed as a participant in the transaction. So we want to make sure that we've got the accumulated information to have proper disclosure of New Ulm's involvement in this deal. So we diligence your historical to make sure you don't overcommit in the future. Some of the ones you talked about that are at 70 or 80%, require a little bit more diligence than someone who's in at 20.
Sure.
Madam Chair, could I ask one question to follow up on Commissioner Swan's? In the event where it's a 30-year contract, in the event that we don't need the volume, and if it's not because of the weather, but because of the invention of the widget, where we don't need anywhere near the natural gas we've contracted with, presumably every other consumer has got access to the same widget, which means that even if BP is obligated to try to remarket our load, nobody else is going to want it. We're still committed to pay what we're supposed to pay if the company cannot sell it to someone else?
No. So what happens is, so you're going to submit a notice remarketing, which means I can't take these volumes. And then that falls into a category of, call it take failure for whatever reason, but it's going to be part of a remarketing. We'll really get into some detail here. And after you cross a certain threshold, we're going to have to reduce your supply contract to measure it with what you can take because of the widget, all the way down to zero if necessary. Now we're finding a home for these volumes, and if we fail to do that, then we're really getting into some detail here. Tax law gives us 2 years to remediate a bad sale. So if instead of selling to a muni, I sell it to Dow Chemical, I've got 2 years to find a municipal system to sell it to. Failing that, then they're gonna require us to retire debt. Or shrink
We're
the transaction.
responsible for that. There's penalties if we're not buying what we committed to buy.
No, there's no penalties. You just lose the gas. The only time you have a penalty is if you fail to take without notice. So just like in your NASB right now, if you just failed to take, there's what's called covered damages, meaning that you would, if you have a gas supply contract with Paul right now, and you don't take on a Tuesday for whatever reason, and he's got to find another home for it, and it's cheaper than what you would have otherwise paid, then you make up that differential. That's in there as well. But if you give a noticed remarketing, let me be real sharp, because you're going to be getting into this thing. There's a cover standard as well, but it's against the contract price, which is less the discount. So you may still have to pay a cover, but only if we can't find a home for the gas at index minus the discount. Okay? So you benefit from that. So failure to take, the cover standard is a monthly price. Properly noticed remarketing, the coverage standard is index minus the discount, which is a lower price, which is better for you. Yes.
So then I just have a little question about the pricing. So you talk about a minimum discount of 20 cents.
Yep.
Now, is that against an index price, or is that against whatever BP's price happens to be, which?
Index
could be-
price.
Okay.
So your market area index.
Okay.
And so maybe it's time I'll kind of index on to page 4 here. So here we've actually covered some of this material already. People sell 30-year maximum maturity. Now, what does maximum maturity mean? So the transaction itself will not be longer than 30 years. We would prefer to be shorter. I think everybody would love it to be shorter. But you want to be able to generate material enough benefit. So the math of these things I told you earlier is advantaged by very long tenors. But if we feel like we can achieve minimum discounts, in this case it's 20 cents, if we can achieve minimum economics by only doing a 20-year transaction, we're going to want to do a 20-year transaction. We're going to want to shorten it. The breakpoint's really, when you're that far out, is 30, 25, or 20. In this interest rate environment, it's unlikely it'll be less than 20. So the final maturity will be no longer than 30. Good things happening to us, maybe as short as 20. And then we're going to have an initial pricing period, and we're going to talk more about that in a second, okay? But we are offering 2 different categories of participation to our municipal clients, and I think you're going to participate in both. One is the long-term commitment. So 30-year contract, 20 cents. So the minimum discount is 20 cents. And we're going to talk about what that word minimum means, okay, in a second. We have run into, so we also have a second category of participation we call short-term participant. In the years of being involved in your space and the years of being involved in these gas prepayment transactions, we have run into municipal systems that simply can't get their head around 30, or just can't get there legally, or can't get there by policy, or can't get there by judgment, or whatever it is. But they do want to somehow participate in these transactions. And so we've created a category of participant that is only in for what we call the initial pricing period. And so I'm going to spend a few minutes on that so we can talk about that. But it's a short-term participant. It's only in for the initial pricing period. And that creates a benefit of a nickel if it's up to 6 years, 6 cents if it's between 6 and 8, and 7 cents if it's between 8 and 10. Now let's talk about what that means. The bonds that are being sold in this case, okay, are being sold to try and take advantage of the maximum interest rate benefit that's available to us. And that right now today seems to be about 6 years. So if you were to talk to a banker, I forgot, do we have a banker here? There's a banker. So if you could you talk to your banker, and you pull up the tax exempt and taxable yield curves over a 30-year horizon, the point where those are widest, the biggest gap between them seems to be about 6 years. And so the bonds that are being priced or sold in this transaction will be sold to have a mandatory tender. They will essentially mature. Bondholders have to give them back in 6 years. At that point, we're going to resell them into the marketplace for another period of time, hopefully to maximize benefit. In determining that initial period, my Treasury Department, so if the bonds are sold to be tendered in 6 years, okay, and we can't roll them for whatever reason, Treasury's got to give the money back that pays them off, right? So it looks a lot like a maturity to them. That's actually why they're letting us do this. It looks a lot like what they do now when they sell debt to mature in 6 or 7 or 8 years. Treasury's given me a window of minimum 5, maximum 10, so that when we come to price this transaction, we can pick the point that maximizes benefits for the participants. Right now, if we did it today, it would be 6 years. That's going to be the initial pricing period. And so the short-term participant is only committed to this transaction for the initial pricing period. After that, you're out, okay? And so shorter tenor, shorter commitment, smaller benefit, and we created this scale of pricing, 5 cents up to 6 years and so on. Quite a few of our participants are doing both. They're getting into both transactions. I think that's what you're considering here as well, okay? But we peeled back the onion here a little bit more on how these bonds are going to be sold. So we have a up to 30-year nominal term, and it's going to be repriced in a chain of periods until you get to the final maturity of the transaction. The initial pricing period will be, call it 6 years, because that's where we would be if it's today. The next one will be, again, no less than 5, probably no more than 10. But you could possibly roll the transaction through to its maturity. Right now, my Treasury Department, who is really taking this money, doesn't like to borrow for longer than 10. So that's why I've got that 10-year outside limit, okay? But nonetheless, it could roll to the end. The business deal with you is about a minimum discount, okay? So when we go to reprice this transaction, we're going to be looking at the interest rate markets that exist at that time, and none of us know what that is. Could be, one thing you know is probably going to be different than today, all right? If that market cannot create a minimum discount, and this is for the long-term participants, because the short guys are done, their contract's over. For the long-term participants, if that can't create a minimum discount of 20 cents, those participants have the option to leave the transaction for that pricing period, because we didn't meet a minimum. But they remain committed to future pricing periods if the minimum can be met then. And that's important to tax counsel, again, because they're looking to have line of sight for qualified consumption over the entire life of the gas supply contract. So it's okay for tax counsel to put on BP shoulders the need to find other qualified load to use the gas during the period that you leave it, if you choose to leave it, all right? But they want to have line of sight that you become part of the transaction again if that minimum discount can be met in the future. So what's going to happen in this dynamic when we actually do this transaction is that we're going to go into the initial price, we're going to sell these bonds, and we will close on success. This thing is only going to close if minimum benefits can be achieved, so that's 20 cents in this case. But if we can get to 22 or 23 or 24 or something higher, we will. It's going to be a function of what those interest rates offer us at the time. But the future commitment you're making is a minimum of 20. Now let's talk about the decision you'll make. So let's say in the next pricing period, and we actually have a chart on this here coming up. In fact, why don't we go to that? Why don't we just go?
You've really covered 5 and 6.
All right. So we'll move ahead to price 7. And so here, what we're trying to do is graphically depict what may happen over the horizon of the transaction. And so you'll see the green arrows across the top are each labeled 5 to 10 years, which is the repricing window that we're operating under right now. So minimum of 5, maximum of 10. And if we work our way down the columns, what we do is we try and say, what's the minimum discount commitment? So we have 20 cents here. What is the market discount? So this is what the market is giving us at that particular time. What is your discount then as a participant? And then we have created something called a repricing reserve. We haven't talked about that yet. But for the initial pricing period, right, And remember, we're closing on success. So the initial pricing period is the only one that you know for certainty what's going to happen because you sold bonds into that interest rate market. We're going to take 5 cents out of the market and we're going to put it into a reserve fund that can be used to help meet minimum discounts in the future. All right? So it's your money. It's just when you get it. And if it isn't used over the life of the transaction, we get to the last period, it has to be used for discounts. So this money isn't BP's money or Peak's money, this is your money, right? But its role, because we know what we've seen today when we price the transaction, is to create a slush fund, if you want to call that, to help meet discounts in the future. So working down to this thing, we have minimum, market, participant, what happens with the repricing reserve, and then what options are created for you, if any, okay? So the first period, we close on success. The transaction only closes if we reach the minimum, which is 20 cents, including the funding of the repricing reserve and everything that happens upstream. And again, we're going to get you the biggest one we can get. So if it's higher, it's going to be higher. But it won't be anything less than 20. In the next segment, which is the next green arrow, I came up with a scenario here. So your contractual commitment's 20 cents. The market gives 30, so we've got a better market, which means the interest rates are probably higher. And so you get the 30. And we didn't use the repricing reserve. The repricing reserve is only collected during the initial pricing period, and then it stays there waiting to be used in the future. All right? And so your option is none. You have none because we met the minimum and you continue with us in this transaction. We get to the third segment and I've got the minimum still at 20. The market's only 17. And here we're using some of the repricing reserve to get you to 20. Which
and
means
that market discount we're talking about is borrowing rates.
basically
Not
determined by
natural gas
borrowing rates.
cost.
Yep.
Yep.
Yep. And so I just chose an environment where we didn't meet the 20. And we use a repricing reserve to get you to 20, so that means you continue. And we're motivated to do that because, again, you're qualified load, right? You're the reason why these bonds are exempt. And then lastly, in the last section, I've got your minimums at 20. Again, the market underperforms, but we got you to 20 with what's left in the repricing reserve. And it says 20 plus because this fund will earn interest over time. And so whatever its balance is in that period is available for that period, and it has to be used in the last period.
Is that fund made up of BP stock, or is it made up of other municipal bonds or treasuries or?
So, good question. So we're going to create this concept called permitted investments that are in the indenture, which is the bond indenture that supports Peak's bond issuance. And permitted investments are things like U.S. Treasuries and agencies. Very high-grade paper.
Okay.
Very high-grade paper.
Have low expectations.
Yeah, of course. Yeah.
Yeah.
Okay.
Yeah, BP stock. Yeah, well, it's I mean, it's a good question. It's a very legitimate, because, and we're concerned about that as well because you don't want to fritter it away, Now, what you trade off is lower interest rates. I mean, when you buy high-grade instruments, you get the lowest rate available, and that's just
But
smarter.
we would get the ultimate payout or the benefit of that would be with whatever income it's generated during the period of time it's
Yep.
held in the reserve.
Yep.
Okay.
Yep. So anyway, 20 plus because we don't know what that balance is. So you can see in this example, I used 3 cents of the nickel in the third segment. I used the last 2 cents of the nickel in the last, and plus means whatever interest earnings, came from that. So in this scenario, you guys stuck with us for the entire transaction because we've always met the minimum. I could have equally written a scenario where the repricing reserve was completely depleted and we couldn't get you to the minimum. And so you would have the option to leave one of these segments. But realistically, I mean, and this is worth a debate amongst you guys as you consider doing this, what would you do? You would only leave this if you had a cheaper option, right? And so the only way to get, again, this is, we started with this is a benefit that's unique to municipal systems. The only way you would get a cheaper option is if there was another one of these transactions sitting out there that you could participate in that had a bigger benefit than what our transaction was offering. And that could happen in some respects because there may be multiple versions of this that are out there, okay? And each one of them are gonna have this probably same concept of minimum discount and departure, and they could lose some of their participants, which create an option for yours. But it's very unlikely that they're all going to end and start again on the same window of repricing periods. March of a year through February, some 6 years later, okay? So, but there could be out there. So you'll assess the landscape and you'll see, you'll determine whether it's in your best interest to stay or to go. We think you'll stay. You're the incumbent, right? So you have that option to stay. But nonetheless, that's the option that's in there. Questions at this point? You guys are good. I mean, this is reasonably complex. So remarketing of gas. So this gets to answering some of the questions you had earlier. What happens if you can't take gas? And there's really two environments that we're talking about. One is just a simple force majeure event, meaning something happened in the system that's a temporary shock and you can't take it. And I think the fixes there are usually you can make it up by taking it the balance of the month or even in the next month. Okay. But the bigger issue we got to pay attention to is what happens if there was a structural change, you know, just in your consumption patterns because of industry, because of load loss, because of widgets. And in that case, the remarketing option exists for you to take those volumes and submit a remarketing notice that'll be in your gas supply contract. So I need you to take these volumes back. You tell us how long you want to us to take them back for, okay? And then we go out and try and find a home for them. But that begins a clock of your inability to take volumes up to your original commitment. And once you cross a certain threshold of non-take, then we're going to reduce your gas supply contract down to what you can take, okay? Because we can't let that continue forever. We gotta be able to react. If there's a widget, like you said, the entire country is probably experiencing it. If you lose some industrials, that could be unique to you. So we really need to be able to, you know, adjust the contract to better fit what your consumption patterns are at some point in the future. Okay. And that, I think, is the end of our prepared remarks. We talked about this page and we talked about this, so I'll leave it with this one. And now you're all experts on long-term gas supply contracts woven around a structured financing.
Don, I think it might have been in the materials, but you had indicated there's a deadline that participants are going
Yes.
to need to be ready to
Thank you.
commit
Yes,
by.
I appreciate that. So, so there's a couple of things going on in terms of calendar. So I've already told you that BP's going to account for this as a borrowing. And so, and we're a reporting entity like any corporation is. And so it's analogous to a securities issuance for us. And so we black out, meaning that we can't participate in the capital markets in a window of time from the close of a quarter and when we announce earnings. So we're in a calendar year, fiscal year, so our quarter closes in March, and our blackout goes through all of April, because we typically report towards the end of the month following the close of a quarter. We are trying to get our transaction pulled together to be able to enter the market in the 2 months between that and when we next blackout. And so we're trying to get in the market then in April or May. Realistically, because of the timing that we got your contracts out to you, we need municipal commitments by mid-April. Okay, no, excuse me, mid-May. I said that exactly wrong, mid-May. Okay.
6 weeks.
And the reason for that is that if we're going to be ready to try and enter the market in late May, so everything I just said earlier, slip it a month. So late May to June, okay, we need to know who's part of the transaction with us, because we've got to do the diligence on you and your disclosed item in the offering document. So we're asking for your approvals by mid-May. Now, we've gotten you the form of agreement and the information packet, so you have that. For the long term, you're going to get the short-term contract probably by the end of the week, which is essentially the long-term one, reduced by all the features that don't apply because you don't have a longer-term commitment. So if you read the one, you're gonna know the other. Thank you for that question. Any other questions?
Thank you.
You're welcome. We hope you come along in this journey with us. It will be a great transaction, and we're looking forward to getting it done.
So I'll offer the motion to receive the presentation on the natural gas prepay opportunity offered by BP Energy Company.
I'll second.
Is there any discussion on that motion? On the motion and second to receive the presentation on the natural gas prepay opportunity offered by BP Energy Company, all in favor indicate by saying aye.
Aye.
And opposed, same sign. The motion carries. Next, we have an presentation by your utility engineer.
Good afternoon. Well, we're doing our safety, SAIDI, CAIDI results again this year. To let you know how we're doing with our indices. Again, this is the actual statute that IOUs are held accountable to. We actually are not held accountable to this, but we do measure these indices so we know how we're doing as sort of a yardstick. Many of you have seen this before, so I'll go over this kind of quickly. The SAIFI is the total number of interruptions over the total number of customers. SAIDI is the sum of the interruption durations divided by the number of customers, and CAIDI is the sum of interruption durations divided by the total number of interruptions. So in 2017, our SAIFI was at 0.26 interruptions per customer, and then you'll see there's a 5-year history that we're carrying through, and now we're down to having 2 of our IOUs. Minnesota Power merged with another firm, and I can't find right now where they're reporting their safety, SAIDI, and CAIDI, but they have to report it, so we'll find it at some point. Again, we're doing very good compared to our competition. SAIDI, we had a 11.2 minutes, a little change, which ours oscillates fairly wildly as you look at our 5-year history, but that's significantly better than both Excel and Otter Tail Power. And here, this is in a graphical representation again. And the investor owns are always a year behind. That's why there's 2016 comparing to our 2017. CAIDI, again, we had 42 minutes, 42 and 6/10, which again, we oscillate fairly wildly, but again, we're better than any of the IOUs. So, developing system reliability, first, of course, our crews get the event restoration of power. Then we find out what happened, SCADA reports, and utilize GIS to account for the numbers that we actually put in to figure out safety, SAIDI, and CAIDI on who was interrupted. This is just an example of why we oscillate so wildly. Again, this numbers are a couple years old, but it still holds true. We have only about 7,200 customers, where Minnesota Power has 143,000. Xcel Energy has 1.4 million, and Otter Tail has 130. So just by sheer scale, we're significant. A few interruptions has a much bigger effect on us than it would them. And then it's the size area. We're only roughly 20 square miles. Minnesota Power is 26,000. Xcel Energy, just for the Minneapolis-St. Paul area, is 108,000 square miles, and Otter Tail Power is 70,000 square miles. So some of the outages we had this year, we actually had an equipment failure on an underground cable, and that's, I'll address that in a minute here. That's why we're changing the way we're looking at some of our stuff. Affected 603 customers for about an hour. We had another squirrel this year that took out 115 customers, and that we had to rebuild the riser, and it did wreck the transformer on that one. The weather-related outages, you'll notice these two are on the same day. Same lightning storm came through, took out 2 lightning arresters on each end of town. So we had, if I remember, it was on a weekend, so crews were running from one end of the town to the other, trying to get everybody back on at the same time. Otherwise, they probably would have been out for less time. And cable replacement. This failure was an underground cable that was installed in the 80s. It was not as good of equipment as we use in our underground equipment now. So we are revisiting, rather than doing overhead to underground conversions, we're revisiting and maybe replacing some of our cables that are reaching their design life or starting to have failure issues. But there again, we're still doing tree trimming, osmosis, pole testing, and then our testing program as always. And then we did complete our ESRI conversion this year for GIS, so it's much more user-friendly and we're using it differently. This year, you notice in your packet, we have a report furnished by the eReli tracker people that compares us to 57 other utilities in this region, so it's a much bigger sample size. And again, we're doing very good compared to our colleagues. We're currently designing plans to rebuild the damaged woodpecker transmission poles going across the river. We're updating our 20-year plans, and we do have a few overhead to underground conversions on areas that are high maintenance that have a lot of issues. And like I said, we're redoing the 20-year stand. We've got a lot of built-in redundancy, able to back up and supply people from the other way, and underground components. Knowledge, keys to reliability. Again, our operators know the system and recognize the problems quickly. And our internal generation does give us quick response if we were to ever lose that transmission line. Conclusions, we're very reliable. We have adequate maintenance, system planning. We're doing a lot of things planning to make sure that we don't have long duration outages, and our technicians and our local generation help with this. Any questions?
On the underground cable replacement you were talking about, so do we have to redig out all the conduits?
The
Just the
project there that we replaced going up the hill, we actually bored it all as emergency repair. Anything that did collapse was bored. Some of the conduit lengths were still good, and those were reused. But about 2/3 of it we had to bore.
And the conduit actually collapsed?
Yep, the older conduit was not as resilient as what they use now. It was poor plastic and stuff, and you pull the cable out and they just collapse. The new stuff, same thing would happen. We'd be able to just pull the cable out and put a new cable back in.
Dan, could you go back to slide number 5, if you would? Because I think that's it's a slide worthy of
5?
looking at. Yeah, page 5 there. That one. And just as Dan mentioned it in his presentation, but 2010 is when Newellm got a direct hit on a storm. And if you look at our size, we typically, there may be other communities around us that get a storm, a severe storm, and we don't bear the brunt of that. But Otter Tail, Xcel Energy, Minnesota Power, they've got lots of territory. Therefore, they got lots of storms going through, knocking out their system. Even though it's a town here or a town there, that adds to their outages. So more territory, more opportunity to fail because of summer storms or winter storms. We've been, pretty lucky in the fact that because we're so small, the only time that we're going to really have a bad situation is when we have a direct hit. Things could go a half a mile north of us. They could go a half a mile south of us. Big deal. Doesn't impact us. But when you have a direct hit like we did in 2010, that's that big blue spike. We had a real bad storm come through, and I think we had roofing contractors here for 4 years. So it was probably as bad as it gets. So our size, because we are so condensed, we can not be subject to the miscellaneous storms that flow through Minnesota from time to time, as much as the Minnesota Power, Otter Tail, and Xcel Energy are more likely to be hit, just because they're so large. A storm is going to take them out. So there's actually reasons for what happens, and so when you see a 2010, don't get too alarmed. That doesn't happen that often, but it does happen. That year we had really dismal safety numbers because we were way above everybody else, but it was one storm. And so that's kind of the explanation. Dan hit on it. I just wanted, because I think it's an interesting visual. Why New Ulm has this big spike? It was a direct hit, much like other communities might have gotten hit by a tornado. Could have went north of town, could have went south of town, but it hit that community. In our case, the last time it happened was 2010. So we'll see that again, I'm sure, at some point in the future.
Yeah, one of the impressive things though, Brian, is that even with that, our other two metrics are still pretty solid in 2010 compared
Very
to
true,
everybody else.
very true, yeah.
So we're, we had a bunch of outages, but we were quick to fix them. So
Yep.
still, even though we were faced that, we still looked solid in those years, in that year, so.
So I think our efforts that Dan went through and explained why we may be where we're at, all the things that we're, as a utility, trying to do to have a reliable system, is paying off. I don't know that you see some of the larger entities, especially in the rural areas, they don't have underground. I mean, they're all above ground, so they're more susceptible to the weather just from that aspect alone.
Any other questions? Or?
Thanks, Dan.
I'll make a motion to receive and file the report regarding the City of New Ulm electric system reliability standards and performance for 2017.
I'll second.
Is there any discussion on the motion? You have a motion and second to receive and file the report regarding the City of New Ulm electric system reliability standards and performance for 2017. All in favor indicate by saying aye.
Aye.
Opposed, same sign. And the motion carries. I think we're under new business. To receive a complimentary letter from the City of St. Peter.
Correct. We received a letter from the City of St. Peter, specifically from Barbara A. Luker, Executive Secretary, I guess reminding us of our assistance to their community, 10 years ago, no, 20 years ago, on March 29th, where a tornado went through Comfrey and St. Peter. And I think that's what, neighbor communities do in situations like that. And we sent crews over to help them out, and I know in the future that they will do the same for us, when a situation arises. So a very nice remembrance thank you letter from the City of St. Peter.
I'll move to receive an order, filed the letter of appreciation from the City of St. Peter to the New Ulm Public Utilities line crew for its assistance in the aftermath of a tornado 20 years ago in March of 1998.
I'll second.
Any discussion? On the motion and second to receive and order filed the letter of appreciation from the City of St. Peter to the New Ulm Public Utilities electric line crew for its assistance in the aftermath of the tornado 20 years ago in March 1998. All in favor indicate by saying aye.
Aye.
Opposed, same sign. The motion carries. And correction, I guess that was not new business. Now we are into new business on the agenda. The first is to consider the agreement between the New Ulm Public Utilities and the New Ulm Economic Development Corporation.
That's correct. The PUC had requested a document be prepared and reviewed by the members prior to acceptance. And this is basically the same format that the New Ulm Economic Development Authority entered into a contract with New Ulm EDC. Only thing changed is the PUC versus the EDA.
And I know we had some discussion of possibly having a commission member sit on the EDA board, and that's not in the contract, I don't see, but we do, in fact, have two.
I think it is in the
Commissioners.
contract.
Is it in the,
Yeah, it's
think
supposed to be
I-
in there.
in there? Okay.
I
Sorry,
think I
just
saw
didn't
it
see
in there. Roger, have you had the opportunity to, you or Tom, to review this?
Yeah, I believe Tom participated in drafting it, and we've reviewed both this and the EDA agreement. This is a contract that would expire at the end of this year, just so you're aware of that.
Okay, well, I'll offer the motion to authorize the city manager to sign the agreement between the New Ulm Public Utility Commission and the New Ulm Economic Development Corporation.
I'll second.
Is there any discussion of the motion?
Just note that number 7 is the identified paragraph that has a PUC commissioner shall be named on the EDC board.
Okay, thank you. Any other discussion of the motion? We have a motion and second to authorize the city manager to sign the agreement between the New Ulm Public Utilities Commission and the New Ulm Economic Development Corporation. All in favor indicate by saying aye.
Aye.
Opposed, same sign. The motion carries. The next item,
Did you want to select somebody to go with that contract?
to serve on the
The
EDA
EDC.
board?
EDC, yeah.
Yeah, who would be the
EDC.
official?
Okay, so Commissioner
We,
Swan.
we have 2 people that are on the PUC that are already on the EDC, correct?
Correct.
Does the EDC need
Another person?
so
No, I think we're looking for whether there's the official representative of the,
Right, designating one.
right, rather than expanding the board, I would assume that perhaps one of you could become the official PUC representative? If you have
Well,
any-
doesn't
Madam
matter.
Chairman, number one, that's not on the agenda. If
Mhm.
you want to suspend the rules, you could do that. Number two, you do have somebody on there. So technically, it's been complied with. If there would ever be a concern about who is the official designee, it might be something you want to address, but you could make it next meeting if you wanted to, or if you want to suspend the rules, you could do it tonight.
Next meeting.
Does any of the commissioner, the 2 EDC members have strong feelings about the issue?
I don't.
No, I don't either.
As long as we have representation with that organization, I think we're fine, and I think we have that now.
Then we can move on to the next item on the agenda, which is to approve an agreement for auditing services.
The city council approved a proposal that we sent out at the beginning of January. We received 6 proposals, and 1 declined to submit a proposal. Of the 6, Abdo Eichenmeyers, which is our current auditing firm, was the lowest in total. And the city council did approve or did accept their proposal last week at their meeting. Staff works very well with Abdo. Everything's gone very well with them in the past, and we recommend continuing our contract with them.
So we don't do it year to year, we do a 5-year
5 years, yeah.
contract with them.
And we're not required to do it. It's just something we've made practice.
Do you have any background behind why the city is the lowest for Abdo and the PUC is the highest of the top 3?
That's just how
How it came
they
out?
split. Yep, how each of the proposals split it. Each of the firms split it themselves. So, I have all of the proposals if you would like to look at them in detail. But
It's close enough.
I'll make a motion to approve 5-year agreement with Abdo Eichenmeyers LLP to perform audit services for the city of New Ulm New Ulm Public Utilities, New Ulm EDA, and New Ulm Fire Relief Association for the audit years beginning fiscal year end 2018 through 2022.
I'll second.
Is there any discussion on the motion? On the motion and second to approve a 5-year agreement with Abdo Eichen Myers LLP to perform audit services for the City of New Ulm Public Utilities, New Ulm EDA, and New Ulm Fire Relief Association for the audit years beginning fiscal year end 2018 through 2022. All in favor indicate by saying aye.
Aye.
Opposed, same sign. And the motion carries. The next item on the agenda is a presentation by Chris Manderfeld regarding net energy billing service rates.
Good evening, Commissioners. This is actually, I'm needing you to approve the net energy billing rates. We do this every year. It's a requirement by Minnesota state statute. And what the net energy billing rates are is this is the rate that is paid back to customers that have a solar, solar installation that is under 40 kW. It's a under 40 kW system. And so if they generate more than what they use, they have the opportunity to sell that back to the utility, and the utility is under obligation under the Minnesota statute to buy that energy back. The calculation is basically taking the total revenue that we receive from a class. So, for example, for the residential class, it's the total revenue that we get from the class, and it's divided, subtracted out. We subtract out fixed costs, which would basically be the meter charges, and then we divide that by the energy to get us a rate. Basically, it comes out to be almost exactly the same every year because we have a annual energy acquisition adjustment to our billing, and our rates haven't changed in the last, well, since 2012, and so the rate is basically pretty close to the same. I think from this year to last year it was about a thousandth of a percent that it changed. So attached to the PUC agenda item is the actual schedule of the net energy billing rates that you are approving tonight.
I'll offer the motion approving the New Ulm Public Utilities net energy billing service rates for 2018 to be effective with the May 1st, 2018 billing.
Second.
Any discussion? We have a motion and second to approve the New Ulm Public Utilities net energy billing service rates for 2018 to be effective with the May 1, 2018 billing. All in favor indicate by saying aye.
Aye.
Opposed, same sign, and the motion carries. Are you? The next item is another report by Chris Manderfeld.
Yes, what I'm asking is for the Commission to authorize staff to direct preparation of a request for proposal, and this is for a cost of service and a rate study for the electric and steam utilities. We have not done a cost of service rate study since 2012. Typically, in the past, we've probably done them every 5 to 6 years, and so it would be about time to do it. We did put this in the budget, so both for electric and steam, there is a dollar amount in the budget to perform this. There's certain things that have happened. You know, the electric market and utility industry changes so frequently, and so I think it's important to do these frequently and not wait too long. We haven't had a rate increase for the electric department since 2012. We've had a flat energy acquisition adjustment since then as well, and so I think it's time to just take a look at what our costs are, make sure that the cost allocation to the different utilities, you know, in example, residential, commercial, industrial, are still falling where they should, and get any recommendations for the next probably 5 years.
I'll offer the motion authorizing staff to direct preparation of a request for proposal for a cost of service and rate study for the electric and steam utilities.
I'll second.
Is there any discussion on that motion? If a motion and second authorizing staff to direct preparation of a request for proposal for a cost of service and rate study for the electric and steam utilities. All in favor indicate by saying aye.
Aye.
Opposed, same sign. And that motion carries. Next item on the agenda is to consider purchasing a vehicle for the wastewater department.
Being Mr. O'Connor is in the audience, I think this would be a topic appropriate for him to explain.
Good evening, Commissioners. Dan O'Connor, wastewater supervisor. We came to you with a request back in November to replace a utility service truck within the wastewater department. I think it was 2013 we got a hand-me-down service utility truck from the gas department. This would be used to do our maintenance at all our outlying lift stations around town. We have 10 lift stations, duplex pump stations, where we're going out quarterly and pulling the pumps to do routine maintenance, and at some point do emergency repairs. It would also be used to enter these lift stations, confined space, using a hoist. So the truck we bought, like I said, was used from the gas department. It's considered a medium duty. We put a crane hoist on that unit and have had some issues getting into the lift station areas to retrieve the pumps. So this is a heavy duty truck with a bigger crane. Give us a little bit more power and adversity to do the jobs that we do quarterly. Total price of the vehicle is about $79,000. That does not include tax, license, and registration. We budgeted $85,000 for this vehicle.
Madam Chair, the only question I had, Mr. Connor, looking at the quotes that you got from ABM, the body and the crane actually cost more than the truck. The first quote on the body says it's for our Ford F-450 truck, but this is a Dodge that you're proposing buying.
Yeah.
Is the quote good for the Dodge as well as
The
the
quote
Ford?
is good. The Dodge was $54 more than the Ford. The reason
This is the extra work. They're quoting it for a Ford. If you look at that first,
For the crane service body.
right, for the body, that's for.
right, and they're both interchangeable. The reason we're not going with the Ford is we missed the deadline for the Ford state bid pricing.
I just didn't know if there was anything unique about a Dodge chassis versus a
No.
Ford where it's going to be.
Both chassis will work for the fiberglass utility box. And the
Thank you.
crane.
Okay, I'll move to authorize the staff to purchase a service vehicle for the wastewater department.
I'll second.
Thank you.
Any discussion on the motion? On the motion and second to authorize staff to purchase a service vehicle for the wastewater department, all in favor indicate by saying aye.
Aye.
Opposed, same sign. The motion carries. The last item on their agenda is to accept claims.
I'll offer the motion to accept the list of claims paid in the amount of $2,846,774.27 and approve the list of claims to be paid in the amount of $405,752.79.
I'll second.
Any discussion? We have a motion and second to accept the list of claims paid in the amount of $2,846,774.27 and approve the list of claims to be paid in the amount of $405,752.79. All in favor indicate by saying aye.
Aye.
Opposed, same sign. Motion carries. And I think that's all we have, so we are adjourned.